Hello everyone, it's Finance Eddie, and today we're going to be talking about the housing market. Now I'm going to show you one article, and this video is going to be a little bit different because it's mostly just going to be me talking. So let me show you the article, and then I'm just going to go off for a couple minutes and tell you guys everything I know about the housing market. First things first, how much can you expect to earn from a real estate investment? Well, since 1940, the median home value in the United States has increased at an annualized rate of 5.5%. So that's the base number we're working for. Now, there's a couple of other factors. First of all, that the homes today have gotten a lot bigger than back then. Now, in countries like Europe, that's not so much of a factor since most of the cities, well, the apartment sizes have stayed pretty constant, seeing as these are all like 100-year-old buildings. But if you factor that in, we're down to 4.6%. And if you account for inflation, that means a real increase of 1.5% per year. But we're not going to talk about inflation in this. At the same time, if you just invested in the S&P 500 in the stock market, you would have produced a return of around 9 to 10%, which is approximately 7% per year after inflation. But this is misleading, and let me tell you why. When you invest in real estate, you're not investing 100% of your money in. Usually, you are taking a loan. So if you have, I don't know, let's say a typical number is something like you pay for 20% of the property up front, and then you loan the 80% from the bank, right? The bank gives you the other 80% of the money you need to buy the home. Well, that gives you a 5 to 1 leverage. That means that you need to multiply this number here by 5 to get your real return, right? Because your return is actually on the 20% that you put in. It's not on the whole 100%. Because if you took the same 20% down payment and put it into the stock markets, you would get 7% per year on this deposit, whereas here, you're getting 4.6% on the whole property, so on 5 times the amount of the 20% deposit. So, if you took the same cash and you put it in real estate and you got a 5 to 1 leverage by putting in 20%, well, if you multiply 4.6 by 5, you get 23% annually, year over year, is what you would be getting back on your investment compared to the stock market where you would be getting 7% per year. And these two numbers are after inflation. So as you can see, for most people, it does make sense to own at least as much real estate as the bank is able to give you money for, which in essence is usually 1 or 2 properties. Why am I bringing all of this up? Well, first of all, I wanted you to understand how making money in real estate works. And the benefit of real estate over stocks is that it's a really easy way to leverage your money in a very, very relatively safe asset, right? In 2008, it didn't look so safe, but it's already back at those levels in almost every country. So it's rather a very safe asset. And what's happening lately? Well, because most people make money on their homes through leverage, let me flip this camera around. Well, as you guys may have heard, what happened recently in the US is that the 10-year Treasury, actually the interest rate on it has been going up, which is a huge red flag. And what this means is that the interest rates in the US are starting to go back up. And that means that the interest rates people pay for their homes goes higher. What does that mean? It means effectively that with the same monthly payment, people are able to afford a lower value of properties. What's the result of that? Well, if people can afford to pay less for homes, the prices of homes tend to go down too, right? Cause reaction. Now, the only exception to this is when the supply side of the homes is actually counteracting this. And this is what's happening right now. There's relatively fewer people looking to buy homes, and the supply of homes on the market is actually, as well, for the same reason, lower than usual. Many people right now are feeling uncertainty, and they're a little bit reluctant to sell their property than they usually would be, which means the supply of homes is low, which is almost exactly counteracting the fact that there's less buyers than normal on the market. So we reached like a new equilibrium, which ended up at a very similar price to what we have now. But when the interest interest rates start to go down, you're actually putting more pressure on the buyers, and it means that each individual buyer can pay less in total for the properties. Now, if we talk the real numbers, well, in reality, it's only gone up a couple of basis points. So let me bring up an article. I've brought up here a history of the US 10-year Treasury. And what we can see here is if we go back to approximately August 2020, that's when it hit a local low at around 0.55%. And currently, it's been going back up quite significantly, and it's already all the way up at around 1.5 again, which is a 3 times increase to the interest rate. Now, what you have to know about this is that what you actually pay on your mortgage, most of it is the bank's margin, and only a certain part of that ends up being this interest rate. So let's say most banks ask for a 2% margin plus whatever the current market rate is. Well, then if you take the 2% and you add the 1.5 to it, you end up with 3.5 effective interest rate. So whereas before, let's say the bank margin stayed the same, which is also not a good assumption, but let's say the bank margin stayed the same. Well, if you had 2% bank margin and 0.5% interest rate, you're paying 2.5% here. It went up. Now you're paying 3.5%, from 2.5 to 3.5. Well, that's not quite a doubling, but you're getting there. And how would this actually affect your house payments? Let's get to that in just a moment. What I wanted to say a couple of seconds ago was that in reality, what happens is when this rate lowers, the banks actually increase their margin. So in reality, the rates won't change from 2.5% to 3.5%. You might see more a change from 3% to 3.5%. You're not going to see a huge swing like this because the banks are adjusting their margins as well to try to keep their overall earnings the same, kind of no matter what this interest rate is doing. So that's important that yes, this does have an effect, but the banks are adjusting their margin to minimize the effect, so you're not going to be able to capture this whole change either on the way down nor on the way up. So guys, let me just bring up a really quick easy calculator from Google, and let's stay with a monthly payment. I don't know, let's give it something reasonable that someone would pay for a house. Let's go with $1,000, right? And let's say before you had an interest rate of approximately 3.5. Well, $1,000 is maybe too low. Let's try to get this to approximately a total value of around, 400,000. So let me break this up all the way to 1,500. All right. Now we're at about $1,700, which when you factor in a 10 or 20% interest rate deposit gets you to around $400,000 worth of house. So that means that you're able to borrow enough to pay for an approximately $400,000 house, right? When the interest rate is 3.5. But what happens if I change this 3.5 interest rate down to 2.5? Look at this number here, okay? This number is about to change. So if I put 2.5 there, well, it just jumped by approximately $50,000. That means the same person, because the monthly payment didn't change. So the same person who could afford to pay $1,700 a month is now able to buy a house that's approximately $50,000 more than it was when the interest rate was 3.5. Let me change this again. So if we go from 3.5, oh, my bad. 3.5, you're able to borrow $380,000. So here, if you're paying 20% down and you're borrowing 80%, this gives you a house of approximately 380 plus 80-ish, so $460,000, whereas at the 2.5% interest rate, you could pay this plus 20%. Let's just do that real quick. So 430 plus, this is not exactly the correct math, 430 plus 86. What does that give you? 516. So your affordability went from being able to pay for a $360,000 home all the way up to being able to pay for a $516,000 home. Now you see the effect that the interest rates actually have on the affordability of the people purchasing homes, right? So a 1% change in interest rate has a dramatic effect on what the buyers are actually able to pay for their homes. So when these interest rates start going up, well, what that means is effectively people are able to buy less homes, or they're able to pay less for the same amount of home. That's why during the coronavirus, because these rates dropped all the way down and because supply absolutely disappeared, the housing market was actually one of the only ones that did not see a drop in price during the corona crash of March. So guys, is this 10-year Treasury interest rate going up a reason to be worried? No. I would say it's a reason to be cautious and probably a reason to think that housing markets will probably go flat for a couple of years, and we're not going to see these 10% increases every year that we have so far been able to enjoy and be used to. Now, rates are going to start to go up again, and that's just the reality of the current financial climate that we're living in. All the governments start to print money like crazy, which is having an effect on what their interest rates need to be, and they're going to do everything they can to keep these interest rates artificially low for as long as they can, and whether they can keep this house of cards going forever, nobody knows. History shows us that, well, it can last for a really long time. This can go for like hundreds of years if they really play it right, by which case, well, we've benefited from that and we don't really care. So is this something to be worried about? No, it's something to be aware of, and it's something to take into account when making your decisions on purchasing or on any decisions regarding real estate investments. Thank you guys for watching. I hope you got smarter. See you in the next one. Bye.